Goodwood works with advisors, foundations, pensions, and third-party investment fund companies to manage their investment assets and meet their financial goals. To that end, we manage growth mandates through our equity portfolios and income mandates through our fixed income funds and segregated accounts. Thank you for listening to our Q3 2023 fixed income update. An inverted yield curve shows that long-term interest rates are less than short-term interest rates. With an inverted yield curve, the yield decreases the further away the maturity date. As of the end of Q3, the 3-month yield was 5% versus the 10-year yield at 4%. My name is Curt Cumming, and as usual, I'm joined by Currie, head of our fixed income investment team and portfolio manager of the Goodwood Milford Fund and Goodwood's segregated institutional and private client accounts. Chris has invested in the fixed income market for over 30 years, including portfolio management positions at OMERS, TAL Asset Management, and as a corporate bond credit analyst at CIBC World Markets. Chris, as an active fixed income manager, you manage duration exposure by moving up and down the yield curve. As a result, our fixed income portfolios have changed considerably over the summer months. Can you please describe why you implemented these adjustments?
Thanks, Curt. I'm pleased to report we made several adjustments to our portfolios during the summer months to help protect capital and increase coupon income levels. We made these changes because we believe the 10-year bond was overbought. We saw and still see short-term corporate new issue opportunities with higher coupons given the inverted yield curve. And we think that rates will stay higher for longer. So we started replacing low coupon bonds with higher coupon bonds as we are not forecasting rate cuts until mid-2024. Our rationale was founded on the tight labor markets and the nominal increases in the unemployment rate. In our view, over 50% of the NBER criteria for determining a recession are employment-based, and we appear to be way below levels of labor market stress. We also saw that short maturity bonds were paying more with the inverted yield curve than long maturity bonds. Given that long bonds are more volatile, we felt it was advisable to reduce volatility and increase income simultaneously.
Chris, the 10-year Treasury yield is an important measure in the financial markets. Investors, economists, and policymakers closely watch the yield as it provides an indicator of economic health and a benchmark for other key interest rates. The 10-year U.S. Treasury hit another 16-year high in early October, prompting an equity market sell-off. However, after the escalated conflicts in the Middle East last week, we saw the long end of the curve rally sharply. Do you see this as an ongoing trend in Q4? And as an active fixed income manager who manages duration, are you making any further adjustments?
The recent rally in long bonds reflect what we believe to be a flight to quality or a safe haven bid as a result of the escalating tensions in the Middle East, and as well as short covering after the severe price declines we saw in September. As a note, the market has retraced a large part of the gains we saw after the start of the Middle East conflicts. We're not changing our portfolio position as we believe the issues that caused the September sell-off are still with us. For example, the Fed's not relaxing its 2% inflation target. Higher for longer has become a mantra. The Fed is not forecast by the market to cut rates, now until the summer of 2024. Inflation is still above 2%, and there's limited signs of weakness in the labor market. It's also the factor that's become more pronounced in the media, the political discourse, and of course in the fixed income markets, which is the higher levels of concern over the potential massive upcoming treasury issuance to fund all the government spending in both the US and Canada. So we believe it's too soon to call a peak in rates. FOMC Chair Powell has said that the economy is reaccelerating, labor markets are still tight, and inflation is not coming down as fast as investors had hoped. As an example, August CPI in the US came in slightly hotter than forecast. So what could cause the current rally to end? Even though it's pretty much recaptured 3/4 of the rally, we would say that short covering has a natural exhaustion point, and the flight to quality bid may succumb to fundamentals, be that accelerating economic growth and high potential treasury issuance.
Corporate bonds generally do well with higher short-term treasury yields and risk premiums. The dark blue bar represents yields in asset classes in September of 2020. The lighter bar represents the same asset classes yield to maturity at the end of Q3. With the inverted yield curve, investors can generate guaranteed returns over 600% above what they were being offered just 3 years ago. We believe the sweet spot is short-term investment-grade corporate bonds. Investors have an opportunity to lock into higher yields relative to the equity market. For example, the average annual return on the equity market since the turn of the century was less than 7% versus the current yield on cash or the 2-year T-bill. With these high short-term rates, one repeating comment I get from clients over and over again is, why not just simply invest in a relatively risk-free 1-year T-bill?
Well, the issue with that strategy, the T-bill strategy, is known as reinvestment risk, which is when your security matures, be it a 3-month bill, 6-month bill, 12-month bill, you're faced with reinvesting your principal in an uncertain interest rate environment. So, for example, if you invested in a 6-month T-bill at around 5.1% now, and at the end of 6 months rates fall, your return going forward from that point is not 5.1%. It's whatever the market rate is for a 6-month T-bill or 3-month T-bill, whatever you choose to reinvestment. Compare this to the return profile from an investment-grade corporate bond in the 3 to 5 year area, with coupons of 5.25% plus. And those coupon levels are locked in for you for the next 3 to 5 years.
The Goodwood portfolios strongly focus on corporate credit. Why do you overweight corporate issues over government issues?
The first reason would be preservation of capital. With any bond, you have a legal contract that you're going to get interest payments twice a year, and you're going to get your full 100% return of capital at maturity. It's important to note that the safety aspect of investment-grade corporate bonds is verified by independent third-party rating agencies that produce credit ratings on bonds. Another reason is that investment-grade corporate bonds always provide higher coupons than government bonds. So corporate bonds are always issued with a higher coupon than the equivalent term to maturity in Canada. And these higher coupons provide a portfolio cushion to help dampen volatility in the portfolio. And lastly, there are 2 sources of potential capital gains in corporate bonds, and those are spread tightening and credit rating upgrades. And the 2 are related. Spread tightening refers to yields falling relative to Canada's, yields down, prices up. Spread tightening can result from a company's prospects improving from such events such as equity raises, asset sales, new profitable business lines, new CEOs, number of factors. And credit ratings are really the ultimate validation of spread tightening. So credit rating upgrade leads to a broader universe of potential investors in the institutional universe. And we know that more buyers equal higher prices.
We manage 3 fixed income mandates for institutions and individual investors: an investment-grade corporate bond mandate, an ESG-conscious investment-grade corporate bond mandate, and of course, the award-winning Goodwood Milford Fund. The investment-grade bond mandate's objective is to preserve capital and provide a high rate of cash coupon income. This mandate is offered to institutions and direct private clients. The ESG-conscious bond mandate's objective is to preserve capital and generate income by investing in bonds with good relative ESG performance and attractive coupons. It's also offered to third-party institutions and family offices. And finally, I'm pleased to announce that the Goodwood Milford Fund has been nominated as a top contender for 2 awards at the 2023 Canadian Hedge Fund Award Ceremony in the best 3-year and the best 5-year credit-focused return categories. The fund has provided investors with a net positive 10.26% compounded annual return with low monthly return volatility since its inception in 2006. Since then, the fund has won multiple industry awards, including Best Sharpe Ratio and Best 1, 2, 5, and 10-year annualized returns, outperforming leading alternative credit-focused and balanced funds. The fund is sold through dealers on FundServe across Canada. Chris, thanks again for joining me on our Q3 update. I'm looking forward to providing our full 2023 review and your outlook on 2024 next quarter. Please feel free to email me if you would like to receive a copy of this presentation.